buying property in Germany in 2024 still possible?
So on the one hand, you have higher property prices. People who are renting, they assume that their rent will stay the same. The average tenancy is like 8 years. After those 8 years, what are you going to do?
Today's guest is Nick Mulder, a Dutch-American entrepreneur based in Berlin. He is a real estate expert who helps people in Germany finance and buy their homes, build wealth for their retirement, and invest in real estate. How much can I afford, right?
Is it possible to buy? It certainly is. It's better to buy early and to buy small than to wait and not buy at all.
We discussed the misconceptions people have when thinking about buying property, whether it's too late to invest, the best tax benefits, how you can retire wealthy, and what people often get wrong when it comes to investing in real estate, and more.
What is that when you buy to let?
In Germany, this is extremely interesting. I think a lot of people will regret not having bought.
Nick Mulder, welcome to the show.
Hello, happy to be here.
You started your career working at Zalando.
Yep.
Then you move to 8Fit.
Correct.
As a lead product, and then head of product in a health tech startup. And then you decided to start your own company, which is Hippo Friend. And now you have also started with Pension Friend and
Invest Friend.
Invest Friend.
Yeah.
I would like to start straight to the point. Is buying a property in Germany in 2024 still possible?
So I think in the end, it's a personal question. So is it possible for who? Is it possible for everyone? No, it's sadly not. I don't think it's ever been possible for everyone to buy. That being said, what we've experienced in the last 10 years in Berlin and in Germany and the rest of the world is essentially people being priced out of the market.
Mm-hmm.
What happened was in Germany in particular, we saw property prices that were relatively flat in the early 2000s, where the rest of the world had a huge property increase.
Mm-hmm.
And so in the 2008 crisis, you saw a huge correction. In Germany, that wasn't actually the case. There was a much smaller correction. And so from about 2010 to 2020 or 2022, you saw price increases of about 5 to 6% per year in Germany on average. So you saw prices, properties that actually doubled in value. At the same time, incomes, of course, didn't double in value. So you see that it gets harder and harder for the average person to buy a home. And in Berlin, that was even worse. So you had properties that have increased by even 2.5x. So you see that it's getting even more difficult for the average person in Berlin to buy. So on the one hand, you have higher property prices. And on the other hand, in the last 2 to 3 years, you have higher interest rates. So part of the reason why property prices increased so much was because it was effectively almost free to borrow money. So I borrowed for my home, I borrowed at 0.9%.
Wow.
So when I saw these interest rates, I knew for myself that this is probably a once in a lifetime opportunity to borrow a lot of money for very cheap. And then the rent versus buy equation becomes very simple. Buying makes a lot more sense. Now, when you look in 2024, we have an equation that's a little bit more equal. So you have a interest rate range between 3.5–4%. A lot of people ask, are interest rates going to decrease? Are they going to increase? Nobody really has a crystal ball, but we are able to look at how the 10-year German bond is priced, and based on that, we can see whether interest rates are leaning towards decreasing or to increasing. And what we expect is a rather flat range between 3 and 3.5% for the rest of the year, despite the ECB already signaling probably 1 or 2 more interest rate cuts in the rest of the year. So back to your question, is it possible to buy? It certainly is for people with, for example, double incomes. So when you have 2 people working, and in the end, it depends what you want to buy. I think what we see now is that people are also resetting their expectations a little bit. So 5 years ago or 4 years ago with 1% interest rate, maybe you could afford 100 square meters. Now, after 2 pay raises, you're still only able to afford 70 square meters. It feels like you're going backwards.
Yeah.
And that's, I think, one of the frustrating things, which is what a lot of other cities in the world have experienced, which is this feeling of being priced out. But there's a concept called the property ladder. And the property ladder is the idea of buying something small, starting at the bottom of the ladder and working your way up. And this notion is essentially that you buy small, you then in a couple of years, you buy something bigger where you use the first property either as a collateral to buy the second property. And so you kind of build your way up to finally achieving or buying that perfect home. So if speaking from experience, the reason why I started my company was actually because I bought a home myself. The entire process was really old-fashioned. I had an old-school broker come to my office, give me paperwork in German, didn't give me any financial advice. And in the end, it was a process that, took quite a while, and it was intransparent how much the broker was earning.
The main question always is, how much can I afford, right? What I have noticed in the traditional mortgage market is that you come already, which object do you want to buy? And then they will tell you if you can afford it or not. But first I would like to know, how much can I afford? And then maybe I will look for something in that range.
Yeah.
When did you buy your first property?
So I bought my first property when I was 25. So I came from the Netherlands where, and the US, where this concept of property ladder was very clear. So we saw decades of property price increases, and this kind of showed us what happens if you don't buy early. So it's better to buy early and to buy small than to wait and not buy at all, because this dream of owning something becomes actually harder and harder.
Yeah, everyone thinks of, I want my dream home, but maybe you don't think so much on the steps. You think that first you need to earn a lot of money and then you can buy it. But by the time that you make that money, everything got more expensive.
Yeah.
With the bubble in the United States, with the properties, do you hesitate in your decision based on that?
To be honest, when I bought, it was a rather intuitive decision. So I was in Berlin already for 2-3 years, and I was at Zalando, and part of the confidence came from the conviction that was around making Berlin a startup capital, and the amount of money that was being invested into the city and the amount of money startups were raising at the time really made it clear to me that there was a gap between the kind of the average housing prices and the people that were moving into Berlin. And so this was, for me, a very obvious sign that prices were going to increase because demand was going to increase. And the housing stock was there's only so much properties being new built in cities. In Berlin, that's about 15,000 new builds every year. And so when you look at the numbers and you see that 30 to 45,000 people are moving to Berlin net, then you can kind of do the math. And
more if you think that a lot of them might be, for example, companies like Zalando or Amazon, they're going to try to bring engineers.
Exactly.
High-paying jobs, and high-paying jobs mean like people willing to pay a good amount of money for a living space.
Exactly. And the other problem is that people who come to a city later are also faced with higher rental prices. So in Germany, you have, a very pro-tenant system. So tenants are very well protected, which is good and it's totally fine. But what that does is it actually creates a bad incentive for immigrants or people who are moving to cities, because they're actually only able to get properties that, for example, are furnished and come onto the market at much higher prices. So the existing rents are regulated by the Mietpreisbremse, which is the rental brake. And so that dictates how much a landlord can charge for their apartment, which is on the one hand good because, it allows people to live in rentable spaces for fair prices. On the other hand, it slightly distorts the market because it's no longer paying the true price of what people are willing to pay. So on the one hand, for example, you have existing contracts that are 10 to 12 euros per square meter. And then on the other hand, you have new build properties, which are exempt from the Mietpreisbremse, which are on the market between 22 and 28 euros per square meter. So you're seeing like a 2 to 2.5x difference between these existing contracts and new contracts. And so logically, if you're someone who who's renting, why should you move, right? Because you're going to be priced out. If that means that the newest or the new property that you'll find is going to be almost twice as expensive, you're of course going to wait and sit on your contract. And this is also one of the dangers of when you regulate a market too hard, is that this disparity increases, which on the one hand leads to reduction in mobility. So people are less likely to leave their flat. If they are going to leave the flat, they will sublet it. And so you get these what we call chain subleases. So I lease it to them and they lease it to them. And then at the very end, it's nothing more than the same kind of capitalist thinking, because everyone's trying to make some euros on the person below them. And this is where you see currently some exploitation. And the people who are, being exploited are mostly the people who come to the cities and who need a job. So whether you're an engineer who's coming and working for Zalando, you have a choice of Airbnb, Wonder Flats, or a furnished place. But guaranteed you're going to be paying over 25 euros per square meter. The chance of you being a foreigner getting an apartment from, a German landlord, and I'm not insinuating anything, but if I'm a German landlord, I'm more likely to be simply going to be renting it to another German. Just because it's more common, I understand them better, and it's less trivial.
Even though there's I see it sometimes also as a risky part. Of course, with a foreigner, you don't know if they will leave or when they will leave, but the advantage is the foreign sometimes don't know their rights, and a German knows them. So if you have a leak in the house or something that is wrong with the flat, the German person will know that they have their right and you have to pay it as a landlord. The foreigner, he only thinks, I just need a place to sleep.
Exactly.
And might not represent a lot of cost for the landlord, but of course there's different sides. It makes me think, because I lived also quite a long time in a very nice part of my neighborhood, in a flat, I think it was 75 square meters, and we were paying 580 euros. Nothing. So nice of course, from that side, it never made sense to buy something, because we will have had to pay double or a bit more than double for a mortgage. But it created this kind of, why should we buy if we rent so cheap? Of course, eventually it was too small for us, because we have a family now. We need to move, and then surprise, rents have double or triple since then.
I mean, that's a common misconception, that people who are renting, they assume that their rent will stay the same. That assumes that you will also live in the same place for 10 years. So I think I read a statistic, the average tenancy is like 8 years. So on average, people stay living in a rental flat for 8 years, but after those 8 years, what are you going to do? And this is the problem that you're describing, which is, typically, let's say you're 24, you're then 32, you then have a partner, you then want to start a family, then you want to find a place where you can go for a kita and look for a family-friendly neighborhood. So I think those are the things that people often misjudge. And of course, in your example where you were renting 75 square meters for 580 euros, that's great until you have to leave house. That's one. And the second is it assumes that you're investing everything, or a high percentage of your disposable income into ETFs or a secondary, investment, whether it's investment property or something.
Which much people don't do.
The majority of people don't do that. They make these calculations. Well, on the one hand you can rent, and on the other hand you can invest, and what they often kind of forget is that it's much harder to not pay your mortgage than it is to skip a month of investing in ETFs. So the flat that I bought when I was 26. it was a hefty commitment. For me, I think it was on the order of 40% of my income. And at the time, it was a new build. And I went through all the hassles of it because, I wasn't... Typically, when you buy a new build, you make sure that you get a penalty in case of delay. And on the other hand, you don't start paying it back until it's finished. Yeah, and there's something called commitment fee-free period where you don't get charged for delays.
Freistellung.
Bereitstellung. Yeah, Bereitstellung. So the thing is, in my case, I was renting, and then I also had to start paying back my mortgage, and that was a really tough one. And that's, for example, one of the things that I really would, when you see, our advisors, and when they're working on cases with new build properties, that's one of the mandatory things. Is to look at, make sure what happens in the case of delays, because typically there are unforeseen things happening on building sites. It's a complex, it's a very complex thing to do. But that being said, at the time it was a huge commitment. Paying that 40%. But what people also misjudge often is that, 10 years later or 5 years later, your income sometimes has grown by 25%, 40%, 50%. So all of a sudden, you have a lot more breathing room. And so...
of course, when you're 25, you're probably in the entry level, maybe already mid-level, but by the time you're 35, you have already become a senior, or you're in a managing position.
Yeah.
That's something that I regret when I moved to Germany, that I did not buy an apartment right away. Yeah. Because, I can understand that my salary in an entry level was not that much, but it was maybe possible for me later on to pay on this.
Yeah.
A lot of people, when they have a pay raise, they tend to increase their lifestyle. But when you have that level of commitment already financially, you still live under your standard.
Exactly. Yeah. It's actually a great saving tactic, because every month you're not only repaying the loan, so the loan goes back into what we call equity, and then you have the interest part, which is the cost of borrowing. So every month you're basically saving. So if you're paying 1,500 euros a month and it's equally split between interest and repayment, over time the interest part becomes less and less, and the savings component increases. But for 10, 15 years, it's always 1,500 euros. So by the end of it, you're actually saving a larger component, and that goes back into the equity part of the property.
Putting it in German terms, the equity is what we call Tilgung. Is it or not?
Yeah, so repayment is Tilgung, exactly. So do you choose 1% or 5% max? And then the Zins is the interest. So typically now you have an interest of 3.5%, and then you have a Tilgung of whatever, 1.5% or 2%. And so the larger majority of that 1,500 euros would be Zins, so interest. So you have... And that's why you have this amortization curve, right? It's flat at the beginning, and it's steeper and steeper, because you're basically repaying less at the beginning, and then it comes more and more. As you repay the loan, the interest on the remaining loan balance is decreasing.
Yeah. In Germany, it's possible to give payments in advance for the debt.
Yeah. So it's called Sondertilgung, which is the ability to repay quicker, and it's up to about typically between 5 and 10% of the original loan balance. Whether that makes sense is another question. Typically, you want to look at what is the opportunity cost. So if you have a 1% interest rate, which a lot of people have who bought it, 5 years ago, or 2%, why would you ever repay 2% interest when you can invest that same amount at 6, 7, or 8%? So here, typically, it makes much more sense to have an investment, like a fund, an ETF portfolio where you're investing in S&P 500, etc. And, making sure that by the end of the fixed interest period, so after 10, 15 years, when the contract needs to be renewed and you need to refinance the remaining loan balance, here at that point, you can either sell your ETF portfolio to cover part of the costs, if at that point in time the interest rate has increased. So that's something we call refinancing risk.
Okay. And for example, right now we have talked a little bit about buying to live. What is that when you buy to let?
Yeah. So in Germany, this is extremely interesting. And this is also why you have a lot of the German classic influencers, property influencers, who swear by renting out. And the reason is simple. It's because you have more tax benefits. So when you rent, when you live to buy, so buy to live, you're basically unable to write off the interest as a cost. So you don't have a tax benefit when you're an own use buyer. When you're buying to rent out, you're earning rental income. Yeah. And at the end of the year, the Finanzamt will say, hey, how much rental income have you earned? And we will tax that at your personal income tax. Yeah. So let's say you earn 100K gross or taxable income, and you make another 20,000 with renting properties. You then have 120,000, and that's taxed at your personal income level. Now, when you're renting out, you can deduct certain costs from this 120K. And the two most interesting things is on the one hand, it's interest. So the interest, so maybe during that year, I paid 10,000 euros in interest. So I can deduct that again. So it's not 120, it's actually 110 again.
Okay.
And then there's also depreciation. So depreciation is a concept where a building becomes worth less over time. So it depreciates. An asset depreciates over time. So you have this, for example, in accounting, when you have, an inventory of Apple laptops. Yeah. So it depreciates very quickly. Right. So after 1 year, it's maybe worth 90%. And that's being, it's rather, let's say 60% and then 40%. And then after 5 years, it's, worth maybe 10% of its original value. And the same concept is applied to buildings, which is very interesting because depending on the year the building is built, you have different depreciation.
But it's just in a book, right?
It's a book, but you basically can deduct it from your taxable income. So let's say I buy a property for 500K. I have 2% depreciation. And let's say the building value is 500K and not the land, because you can't depreciate land value, only the building value. So 500K, 2%, you're looking at 10K. 10K a year that you can then depreciate. So
plus the 10% interest, the 10,000 in interest that you were paying.
Exactly. So you're looking at 20K that you can then deduct. So basically in your net equal, right? So you're actually not paying any tax on your rental income.
Okay, but that's just on the income that you get on your rental.
Exactly. You're on your overall income. And this is where it gets very interesting now with the new build properties, because first of all, new build properties have a 3% depreciation. So have a higher depreciation than old buildings. And you now have a special depreciation, which is used to incentivize new build development. And this is the new company that we've created called InvestFriend, where we go and we search in the market. We look for projects that are eligible for special depreciation.
Okay.
Because the special depreciation is 5% depreciation per year in the first 4 years.
Okay.
Assuming that the property is under 5,200 euros per square meter. And so it's only subsidizing efficient new builds that are relatively low cost. So not luxury new builds, but only affordable new builds. And these new builds are typically within half an hour or an hour of major cities. And we call that satellite towns. So one project we just recently did was in Sulzen. So it's in Brandenburg. It's about an hour, 45 minutes to Berlin. And the project, I think we sold it in about 3 months. So the main selling point is you have the tax benefit. And over 10 years, you have a tax benefit depending on your personal income tax and how much income you're making on the order of 50,000 euros. So that's 50,000 euros that you can deduct from your taxes over 10 years. So in that little example that we did before, you take the 10K. But imagine that's just for, what did we say, 2%. Imagine it's 2.5 times that. So you're looking at 25,000 that you could deduct from your taxes. Right?
Okay.
And so if you're on on a 40% tax rate, that's 10,000 euros in savings.
What's the incentive there for the government? What are they trying to do? That people buy more so they can provide more possibilities to rent out?
Or yeah, so they're trying to stimulate building of these, right? So in the end, the new build segment is driven by developers building, but also people wanting to live in new builds. So
you get that because you get the benefit. You get the benefit of the depreciation as well, even if you live there.
No,
only if you rent it out.
Only rent it out. So they're incentivizing new build developers to build because they know that investors, private investors, so you have doctors, lawyers, dentists, you name it, who are earning, over 100K gross with higher taxable incomes to then buy these new build properties to rent out. So they're trying to stimulate private investment in new builds. So and that's what we see now a lot of the time as well. If you have people who, for example, let's take your scenario where you had your 75 square meter for 580. Perfect opportunity to invest your additional disposable income or savings into a project so that you have that little bit on the property ladder, because over time that property in Zulsen is also growing or appreciating. Population growth, you see a number of factors that are contributing to the property appreciation, especially when satellite towns are built closer to a major city like Berlin.
But from what you say, it makes a lot of sense then to buy to let. And what are the risks? What should I be aware of if I want to do that? I mean, there must be always
so I mean, there are always catches with everything. So one of the biggest risk is that the developer doesn't finish.
Okay.
The second is that they don't finish on time. And then the third is that you have a suboptimal tenant. Now, of course, the tenancy rights in Germany are strong, but they are still, like anywhere, you can't not pay your rent for a certain amount of time. This would be a reason to cancel the contract. So that's the third biggest risk, is that you have a bad tenant. Now, with InvestFriend, we've worked with a developer to find a solvent tenant, and that's also one of the guarantees for the investment.
I would like to know a little bit more about your journey as an entrepreneur. What motivated you to start HippoFriend and then PensionFriend and now InvestFriend?
I think I always knew that I wanted to be an entrepreneur, starting from the early days of living in the US, where I did lemonade stands and was snow shoveling in the street. So I was always a bit of a self-starter, a little bit different from my brother and sister, very independent, and always had to find ways to make money, or was always interested in solving problems. So it actually started in university, where after my cycling career, I was a semi-pro cyclist for a long time, but at a certain point I had to give up on this dream. So I had a bit of an issue, which was I had a very big legs and very small upper body, a classic cyclist body. And I wanted to go to the gym and correct that, so to say.
What's the perfect body then? You need to have very long legs?
So for cycling, it depends if you're a sprinter or not. So I always wanted to be a climber, but I was never really suited for that. I was actually more suited to be a sprinter. And that's something I only figured out towards the end of my career, that I had quite explosive muscle type. But yeah, so that being said, I was let's say for 4 years, I was on a very strict diet. And body fat of 8%, 9%, so really kind of lean. And as little upper body muscle as possible, because this doesn't really bring you anything in cycling. So I had a bit of a lopsided shape. And so actually I started going to the fitness studios, and that's where one problem kind of came about, which was, how am I tracking my workouts? And this is actually how I started one of the first apps, which was called Fido. It was a workout tracking app, which allowed you to kind of like Spotify drag and drop workouts, and show you how the exercise was done, but also show you kind of like a notebook would be used for tracking back in the day, when I think it was maybe 14 years ago, where you would write down your reps, your number of sets, and then the weight. So this was kind of the classic problem, and that's the one that I started working on solving with a co-founder, and that's how I got into building and designing. So I kind of did everything there, from growth marketing to designing to front end building. So did the whole kind of thing, and then
did you go to market?
So we went to market. We got, I don't know, 15,000 users, 20,000 users. So
nice.
It was like, this was like back when Facebook was big. So I used Facebook groups a lot to kind of find people interested in working out, get feedback. So I was like probably very early on in the, you know, in the iOS days. So design was always like, yeah, looking back at it, it's probably, we would laugh at it now, but back then it was very modern and cool, slick.
Yeah.
And that was around the time I was finishing my master's, which was in like kind of data science, BI, and that's around the same time that I got an offer from Zalando to work there. And that was a bit the decision: do I stay in Holland? Do I go to Amsterdam, work there as a whatever IT consultant, because the apps weren't really making enough money to live off of, or do I go to Berlin and work at this shoe startup? And so
Which year was that?
That was 2014.
Okay, still very early, and the very early days from Zalando, I guess, right?
Yeah, so I was very fortunate that the person who interviewed me and hired me was the first employee, so Christoph Lange. And they actually had a really good mentoring program. So I started there as a trainee in product, and I could switch every 6 months to different departments. And so I had the kind of the fashion store, they called it, which was the classic e-commerce store. Then I had, I think, logistics, and at logistics is where I again started my entrepreneurial journey, because I went there and I wanted to build same-day delivery. So this was where me and an engineer, we basically went to the warehouse together with another product guy, and we started hijacking the Zalando parcels, putting them on a van, and then we drove and we delivered them ourselves. And then we wanted to kind of interview the customers to see what their experience was, to get a 2-hour, 3-hour delivery. And this was enough evidence to then go to basically pitch this to Robert at the time. And then we could get a small budget, and we were able to build a same-day delivery app, which was a bit of a playground for testing same-day delivery.
Do they have that now? Well, they have now Zalando Plus, right?
Yeah.
Which is a faster delivery, but still not same-day delivery, I guess, right?
So I think in the end you have, I don't know exactly what's left over, but it was basically like a pilot to get the whole infrastructure built, because it's not just about what you see online. It's also, you need what we at the time called parcel hubs. So we needed to build little warehouses inside the city where we could then redistribute the parcels for the last mile delivery. So we basically had 20 cars lined up in a small Weissensee like backyard kind of office garage thing, where we then had to distribute the parcels. And that was like
but that was super exciting.
That was interesting. Yeah, that was a fun thing to do, and I really enjoyed. I think that was cool that Zalando enabled that kind of entrepreneurial.
Yeah, because it feels still like building your own company. I guess at that point, right?
Yeah. And that was a time where they basically had a number of internal projects.
And then you went after that to another, now a bigger company dedicated to fitness, right?
Yeah, that was called AFIT. So there we had, a couple million users. And for me, I was like leading the product there. I was working very close with Pablo at the time, the CEO. And
he's from Barcelona, right?
Exactly. Yeah. So Pablo and the whole team was Pablo, Pedro, Thomas. So Thomas was French, but they all had a very Spanish background. So I think now they I don't know
You were
exactly
in the office in Stralauer Allee?
I
Next
wasn't
to-
there. That
Oh.
was at the end. So
Ah,
I was
okay.
there before. I was in Paul-Linke-Ufer. So close to
Okay.
Marley's Spoon. Is this what it's called?
Okay,
Yeah,
the same building we were
exactly.
there. Yeah.
We work in
Exactly.
the same building.
Yeah. So one of
Amazing
these
building.
Well, no, it's same street, right?
The same building.
Really?
Marley Spoon was in the same building
behind
with
Zola.
with a coffee shop in the
Yeah.
in the entrance.
Exactly.
Yeah, by Sola.
The
Yeah,
concierge.
I missed that place.
Yeah, it was good. The coffee.
And then I was working also in Stralauer Allee,
Okay.
Horizon Studios, and in the second floor or the first floor,
Next to Tax Fix as well, no?
probably. But I remember only the sign of 8fit, and that
Mhm.
was a lot of people from Spain working
Yeah.
there. Yeah.
Yeah, they had a very Spanish team. Yeah, it was a lot of fun building there. So there, I have to be honest, was a lot more experimental than Zalando. So a lot more data driven.
Mhm.
Zalando was a little bit more, I think, traditional German,
Okay.
and 8fit was very modern at the time with using Amplitude to do A/B testing and running lots of different experiments, tracking cohorts. So this was at the time in Berlin rather unusual, and I think their DNA was very data driven. And
Okay.
that was cool to experience because that's what I then took away to work on Ada Health and build a much more data driven company,
Yeah.
because that was much, let's say, it was a traditional product for doctors, and we basically converted that to a B2C app for consumers to do diagnosis.
And then when you decided to leave there, you had an epiphany, and then you decided to build Hippo Friend, or
So
was
at Ada, I was it's when I bought my first home. So that's when I went through that experience, and I kind of had this epiphany where it's like, okay, if we can use AI, was what we called it at the time, but it was an expert.
if else.
Yeah, let's say a very complicated version of that.
Okay.
So not to speak badly about it, I think they had a very sophisticated reasoning engine. But the thinking was, okay, if we can do this for medicine and for diagnostics, we should be able to do this for financial products. And this is where the thinking kind of evolved. And at the time, I was, I think, on a bike ride with my dad, and then we were discussing this, and he came from the World Bank and IMF, where he'd been working in finance for 3 decades, and I came from the product development side and the growth side, and I thought, hey, I think we should test something, and we started testing, and we could see that there was definitely some kind of demand here, and it took about a year before we figured out product market fit. We started with a refinancing product for Germans, which was completely rejected.
Okay.
So it was accepted in the sense that people love to calculate how much they could save by refinancing, but we couldn't actually get them to get a new mortgage through us, or let's say through our partners, because at the time we weren't even a legal mortgage broker. We were just doing lead generation for other mortgage brokers. And then it took us a year to become a mortgage broker, hire
lawyers.
No, not even lawyers. It was actually, we had to hire our first mortgage broker, and he was very experienced, and we knew the finance side, but we didn't know the local rules and how exactly it worked in Germany. And so we kind of were able to extract a lot of information from him, the platforms, how everything was set up, and then we built a product based on that.
I see that a lot of the things that you're doing lately are driven to help people to create their financial independence or financial freedom, right? You have talked in your articles about the pension gap. Talk to me a bit more about what is this pension gap and what motivated you to start Pension Friend?
When we were doing mortgages, we saw that during the low interest era, when you had interest rates of 1%, the difference between putting down a lot of savings and not was maybe 20 basis points. So the difference was between 0.8 and 1%. And so the logic was the return that you're getting on your, the relative, or let's say the absolute return that you're getting on your savings is very low. And so what that meant was that we typically would see that would make much more sense to invest, to go for a relatively high leverage, so a higher loan to value. So you'd borrow a higher percentage of the property value. And instead of putting all your savings into the property, you would put it into ETFs. And so we saw a lot of people who would say, okay, instead of going for 80%, I go for 95, and the 15%, instead of 80, I invest in ETFs. And so we would then basically advise them, hey, like, you shouldn't repay a 1% mortgage because we're telling you this is very low. We know this is low. And then you still had people who said, no, I want to go for 80% financing. And so this is kind of how this idea was born. And then we looked at, okay, how can we invest in ETFs in a business model that makes sense for customers? And we then discovered that in Germany you have the private pension plan, which acts as like a tax wrapper. So what that means is that within the tax wrapper, you're not paying tax on rebalancing, and you have a tax break for holding the pension plan till 62 or 12 years. And that tax break amounts to only paying the gains, capital gains, on half of the total value. So, over 20 years, 30 years, your ETFs are growing, but every year you're paying capital gains on the gain.
Yeah.
That's the one. And then you have your gain, you have your withholding tax, and then you have your rebalancing. So when you're buying and selling. So every time you buy and sell, every little bit of gain is being taxed. So at the end of the year, you actually have a tax bill for, several different things. And the benefit of the tax wrapper is that you're not paying any taxes until the end. And then at the end, you're only paying half. So it's a large tax break. So again, very, very classic German product. And then the second thing is that a lot of people come to us, and they don't really have a clue about which ETFs to invest in. You have thousands of ETFs. The classic ETFs are the S&P 500 and the MSCI, and the difference between those two can be as much as 2.5% per year. So after 30 years of compounding, that's it's a huge difference. If you're putting in hundreds of euros every month. So helping people set this up, this private pension plan, doing the rebalancing for them in a way that's tax efficient, they're actually able to retire earlier with more.
Yeah, because we have this problem of this pension gap that if you want to retire with the same amount of money that you're earning right now, netto, that's not going to happen. If everything is good enough, you probably retire with the 60%.
I would say 40%.
40%.
Yeah.
Okay. Wow. Which is not enough because like the life expenses increase over time.
Exactly. So this is a major problem, which is, on the one hand, you have an aging population in Germany. So that means the number of people who are working for those that are retired is decreasing. So as you have more and more elderly and you have a smaller working population, that ratio is decreasing. So that means, on the one hand, elderly are living longer, right? So you have more people over 67 who are not working, and you have fewer people below 67 who are working. So you basically have this lopsided population, which is very difficult. And so what that means is that the public pension system is, which in itself is a good system, and it's well thought through. The problem is that it's too little. So you need to supplement your pension income with either an investment property, your own home, or private pension plan or ETFs.
Okay.
So you need, and for us, we say the perfect financially stable retirement looks like you have your ETFs or private pension. So whether you invest directly or via pension friend, that's one question. The second is an investment property. So you have rental income. Yeah. So the tenant is basically paying you monthly 1,000 euros. That's one. And then the third source is your own home. If you have your own home, you don't have any living expenses. Yeah. So if you have these three, you have a third, you have 100% of your needed income.
Private retirement insurance, a rental property, and your own home will be the ideal way to have these three.
Yeah.
Seems quite hard.
Well, yeah.
It looks difficult for most of the
Well,
people.
the thing is, you need to start small and you need to start early.
Exactly.
So it's a huge benefit if you're starting at 20 or 25 with a small ETF and you're paying 50 euros or private pension and you're paying 50 euros, 100 euros a month. This compounds over time. And just like ETFs allow you to participate in the world growth, or let's say the US growth with the S&P 500, the same as with buying a property. You're participating in a city's growth. Yeah. So if I buy a piece of land and piece of a building in a city that's growing over time, which of course you have people who will say, no, like the world is doomed and the cities aren't growing because of AI and this and that. Well, I would disagree. The same could be said in the 1920s, industrialization, etc. You see cities, people want to live close to people. Yeah. That's just how human nature is. Even with AI, we will still always want to be close to each other in some way. We're very community driven. So I'm a strong believer that cities are still going to be a concept that exists in the next 50 to 100 years. And so when you're investing for retirement, you have to look at, am I owning a little piece of a city? For example, with Solson, okay, it's on the outskirts of Berlin. That might be the outskirts now, but what does that look like in 30, 40 years? If you look at Paris or Amsterdam, those outskirts are now, you have layers of centers, right? So in Paris, it's very clear. You have all these, it's like an onion.
Yeah, they call it rings.
Exactly, rings. So you have 14,000 euros per square meter in the center, and then it goes out rings to 8,000 or 6,000 at the edges, and Berlin is still 4,000 at the edges, and 9,000 in the center. So it's a little bit like, what do you want to have a piece of? Do you want to have a piece of the world's economy, ETFs, or pension plan, or do you want to have a piece of a city? A city's growth.
Yeah.
And I think that's how I look at it. And I think in the end, in a perfect world, you have a little bit of both. And this is how, when you have your own home, your own roof over your head, an investment property or a piece of a small city, and then part of the world economy as another little bit, you have a very stable, forward-looking, even if you're expected to live till 90, you have a very positive, forward-looking outlook.
Yeah. You said you're a capitalist at heart in one of your posts, and that you believe that the market can regulate itself. But do you see any downside letting that big companies such as BlackRock or other bigger consortiums, bigger corporations control the living spaces of families and elderlies globally?
So I'm a capitalist at heart, but I believe in social responsibility. So you need to have checks and balances because a free market that runs wild will, as you see, like in the US, where I will never live again, you will see it run and continuously profit maximize. So I think profit maximization at the core is also, it's very dangerous because when you look at the stock market, these are numbers and the only thing investors care about are returns. They don't care very much when you look at, social responsibility when it comes to global warming. It's sad to see how little, when you look at ExxonMobil or some of these large oil companies, Shell in the Netherlands, how they're actually winding down some of their futuristic projects, and it's applauded by investors. It's just very sad. So I might be a capitalist at heart in the sense that I believe that the market should determine prices. However, the role of the government should be to create a framework where the market can play. And they need to define the boundaries within the market needs to play. So for example, right now, the government, or Berlin government specifically, I believe has overstepped. And they've regulated the rental prices too much. And the problem now is that investors and builders are not willing to build because it doesn't make sense. It costs too much to build that the basic economic principles of can I return something on something I build? Why, if I can choose between Berlin and Cologne and Munich, why would I build in Berlin?
Okay.
So in the end, it's about a projected cash flow, and I need to be able to guarantee a certain amount of return in the future. So on the one hand, you need to have this thinking, which is like, it needs to be investor friendly, because if nothing gets built in Berlin, you have immigration towards Berlin, prices will increase, and it will become unaffordable to the point that the city and the culture will change, or you will get such a disparity between the rents, old contracts and new contracts, that you're going to have this really weird gray zone in between, right? With the subleasing and furnished rentals, which you already see now.
Yeah, because if the apartment is furnished, then there's almost no regulation on that, right? You can put any price.
So that's not true. So this is a common misunderstanding. You're only allowed to increase the rent by a certain amount, which is relative to the furniture value. So you can basically add, for example, let's say you have a kitchen, costs 10,000 euros, you depreciate over 10 years, 1,000 euros a year, 1,000 euros. You can then say, like, per year approximately, you can add on top. I think that's more or less, but don't quote me on this, that's more or less how it works. So let's say you then have a painting and a furniture, and so you say if you have expensive furniture, you can then add more. However, this is a gray zone because no one really knows what the furniture is worth. So a first step would be, you have to list exactly what furniture is in the rental contract, and then you have to say the value, and then you have to say how that relates to the rental price. So that's a gray zone that's currently being exploited by a lot of landlords. And yeah, part of the reason is they have to do that because, you know, the rental prices are 12 euros per square meter. The mortgage costs are a certain amount. You have the other costs. For them, it just doesn't make sense. And, you know, of course, you can say, is housing an asset, or is it like a
right?
A basic right, exactly.
No.
That is something that you can, you know, argue about, whether let's say you have social values or capitalist values. I think that the true answer is somewhere in between. You need to have a government which owns a certain percentage of the stock, in my opinion. And you need to have incentives that make buying not that much better than renting. So, for example, what I know is in Switzerland, there are certain incentives that actually penalize buyers for owning, that make it more equal to renting.
And what about policies that allow people to buy a home to live?
So there are a lot of KfW subsidies. So KfW 124, you get 100,000 euros at a slightly lower interest rate, but it doesn't really move. It doesn't move the needle very much because it's just a slightly lower interest rate. And the key problem is still in Germany that you have to pay your upfront costs. So you have to pay them the property transfer tax, the notary fee, and sometimes the real estate commission. It can add up to almost 11% in Berlin. So without real estate broker, it's 8%, but still 8%. Imagine you buy 300,000, that's 24K, which should be achievable for people, you know, working in tech. But if you're not working in tech, you know, how do you save this amount of money? So I think back during the 1% interest rate times, I think a lot of people will regret not having bought. This was a once in a lifetime opportunity, and you still had people who would put down more savings. Like, if you were really financially optimizing, you would put down as little savings as possible and buy several times. You would maximize your leverage but yeah, that is again, when you try to over optimize, you kind of start optimizing at the cost or at the expense of others. So you need to find this balance between social responsibility of the government being able to guarantee certain rents, or at least, you know, subsidizing it so that the weaker, poorer parts of society are able to also participate. At the end of the day, though, it's a city. So a city, not everyone can live in the city. So there is a supply and demand here at the core as well. And the question is, who deserves to live in the city? Is it elderly? So now you have a problem that elderly, for example, maybe one partner dies, and then they have this 100 square meter property by themselves.
Yeah.
And they're holding on to this because they can't go to a nursing home, it's too expensive. They can't go to another rental, it's too expensive. So you have this problem of elderly who are also, their living space, so to say, has increased.
Mm-hmm.
Whereas you then have the younger generation who is left with very little.
Yeah, but they could also sell it and buy something smaller.
Well, that would be the one logical thing. However, try selling something and going through that whole process.
When you're 80 or 85.
Yeah, when you're 80 or in your 80s. But I think that's, so in Germany, what you see more often is the inheritance. So, for example, in this case, the 75 or 80-year-old would grant the property to their children or grandchildren so that they can save on tax. So you can inherit up to 400,000 euros every 10 years, tax-free.
Mm-hmm.
So you would basically gift parts of the apartment. And this is part of the problem, is that you're basically creating this society of have and have not, because you basically have either rich parents or grandparents who gift a property or part of a property, because on your own wage, it's going to be very difficult to afford.
That's what I see with a lot of people I know that are Germans whose parents have already given them part of their inheritance money.
Yeah.
And there's this big disadvantage, because I think on the part of property developers, they think, okay, people have more money in their pockets, we can increase the price, but it leaves to those who don't have parents who have money with this disadvantage that we only depend on the money that we can save, and some others, they just get 200 or 300,000 euros in cash, and that creates a big disadvantage. And we missed our chance, Benji.
Yes, I know.
We missed our chance.
Yes,
I'm
I
super
know.
angry.
But I mean, another thing that is happening also for immigrants is that when they see that they cannot buy in the place that they live now, they normally try to buy something in the country of origin. That happens a lot with Mexicans.
We did, or I did already. You did as well, because I cannot buy here. I buy in my home.
Which is also, in the end, it's like I said, it's about owning a piece of that city. So better own a piece of a city than owning no city at all. Whether it makes financial sense to own something in Mexico City, I really don't know. And whereas with Berlin, it's like
it's a capital.
It's a capital. But I do want to say one thing: it's people always think they've missed their chance with real estate. And there's a saying which is the best time to invest was yesterday. And when it's today, you can always apply this logic. So when you buy and hold real estate, it's typically on a 15-year horizon. And if you look at any kind of cycle, typically you have 5 years where it's a little bit less, and then you have 7-8 years of increases. In Berlin, it's been crazy with 12 years, of a 12-year positive cycle. So now we've had 2 years where it's, correcting, but at the same time, it's been a correction of 7%.
Okay.
Compared to 2010, it's doubled. So, you can also just hold your property for 5 years longer, and that's a little bit the power of property, is that on the one hand, it's a very long-term game. On the other hand, it's leveraged. So it's not for €1 that you put in the ETF market that you return 8%. So you get, your 8 cents. It's actually, you're putting that €1 in, but in return, you get €10.
It has to do a lot with financial education, I think. Growing with your father work in
IMF,
Yeah, because the way at the beginning, how you describe your logic on renting and the interest rate and all of this terminology and how to plan on the next 10 years, your financial projections is something that when I was 25, I didn't have.
Well, the reality is I didn't actually have it either when I was 25, even though I'd studied finance, because it's such a personal finance is such a particular topic. It's not very well taught in university or school. So also in the Netherlands and the US. So I studied economics, and you learn about microeconomics and macroeconomics and supply and demand, but you don't really learn about the interest rate and the repayment rate and how to how to approach personal finance. And I think that's what I've also had to learn. And I was able to gain a lot of knowledge from my father and basically break that down and also explain it in layman's terms. So there's a lot of stuff that in ways that he talks about finance that don't make sense to me, and then I have to understand it, and then I can translate it, and then put it in simple terms. And that in the end is also part of the DNA of why we call ourselves a friend. So Hippo friend, or pension friend or invest friend. We want to be the friend throughout the home buying journey or the financial journey. So we're there, just talking like friends would talk with one another.
Do you ever see this interest rate coming down again to 1%?
To 1%, not. I think this was really an era of
what was the cost of having it like so low?
The cost was that you basically have inflation of all assets, right? So once everything is so cheap, people borrow a lot of money and they bid up prices. So you have the money supply increased drastically during this time. And you see it with every asset. You look at the S&P 500 as well, also grew, year over year of between 10 and 15% on average. So during that time, so the downside is that everything just got more expensive when there's more money slushing around in the system. So will that happen again? I don't think so, because you can never say what happens in 10 years. But I don't expect it in the next 5 years. And it's also not something I would bet on, like a difference between 3% and 2%. I think it's much more important whether you buy now or in 2 or 3 years.
Okay.
Because, for example, property prices in Berlin since the beginning of the year have already increased 2.5%.
Okay.
So, like, when you look at it, you can speculate on the interest rate being 0.5% or 1% less or more, but if the property price changes by 2%, 3% per year, you're playing the wrong game.
All right. One last one.
Yeah.
When you moved to Berlin, what difference you see from the Nick from back then and the Nick from today?
That's a good question. I mean, the Nick back then was very driven and focused on achieving goals, and I had a cyclist mentality and a huge ego that went along with it, of always trying to achieve the next thing. I think now I'm a little bit more grounded. I try to build things that help people and find joy in building it. I think that's kind of finding my purpose. Yeah.
It was very nice to have you here.
Thank you.
I hope the audience have learned a lot about the real estate market and financial markets. If people want to learn more about you and your insights, I think they can follow you on LinkedIn.
Yep.
I hope to see you next time.
Yeah. Thanks so much for having me. It was really nice to talk to you guys.
Thank you for coming.
Welcome to the show. It's the Golden Tide Podcast. It's the people who make the city. It's the city who makes us people so great.